Thanks very much, Omri. That was a great presentation. Our next speaker is Nick Balkin from Ford Asset Management. Nick is one of the multi-council portfolio managers on the Nedgroup Investments Stable Fund. The fund aims to outperform inflation plus 4% over rolling 3-year periods, while also protecting capital over rolling 12-month periods. Over to you, Nick.
Thank you, Anil. Today I'll be talking about the Stable Fund third quarter update. As we entered the third quarter, we had a very strong US market, which was driven by expectations of rate cuts. As inflation expectations started to come down, the market started to build in almost 2% additional rate cuts. To be honest, we think that in 2025, we think that there will be a re-emergence of inflation, and we are quite cautious that this low inflation will stay where it is. We also think that globally, we're entering quite a risky period, both politically and geopolitically, with all the US election coming up and I guess issues in the Middle East, issues with Russia, Ukraine, and obviously the US-China issues. And we also enter South Africa, where we enter the fourth quarter coming, where the SA economy is doing really well. We do think that there is a tactical opportunity as electricity improves. Importantly, there have been initial signs of structural changes, although it is quite early. Having said that, the markets, especially the bond market and some of the larger cap equities, have started to build in that positivity. So we do think that SA bonds look quite expensive, but importantly, there is still opportunity from an inflation-linked point of view. We can still get 4.5% above inflation by buying some of the inflation-linked bonds. And obviously, gold remains a really good diversifier. It has performed really well for the last quarter, and it is performing strongly into the fourth quarter. But importantly, you don't know how the future will play out, and it is important to have diversification. Turning to the performance for the year, you can see a very strong absolute return number at almost 13%. It has started to mean that the 3 and 5 year numbers have improved. We're very proud that the real returns remain quite strong across all time periods. It absolutely was helped by obviously a really big pickup in the Chinese economy, which has helped the 1 year number, although there were many different contributors. This is just showing the performance, I guess, in another way, where you can see the Nedgroup Stable Fund, although not performing in line with peers over a 1 year basis, has provided a very good return over 1 year, and especially against inflation. And as you can see from a 3 and 5 year basis, also performing very well. Turning to where it came from, where did the performance come from? I guess it is a third quarter update, so it is important to talk about where the 3-month performance came from. It was quite evenly distributed. Obviously, the South African equity market did very well, as did the SA bond market, both in rands and dollars, interestingly. Gold contributed a little bit, obviously at 0.4%, and then the foreign assets was a big contributor, notwithstanding the rand strength at 1.2%. So it was relatively evenly balanced. And as you can see, the biggest contributor on a 1 year basis, as you'd expect, is the SA bond market, which contributed quite substantially. Given our 10% weight in the SA equities, we did very well, but it wasn't a huge weight in the overall portfolio. But as you can see from a 1 year basis, it was actually relatively evenly distributed. So as I started at the introduction, you can see the light blue bar is the Chinese economy, and the yellow bar obviously is the Chinese equity market, and the yellow bar is the US equity market. As you can see, the huge rally that we talk about in the third quarter, that 24% up, you can see that light green bar bouncing, but you can see there's still a huge gap to make up. So we are thinking that although there has been a big repricing in some of the Chinese companies, there's still a fair way to go, both from a valuation point of view, even if the economy doesn't pick up at all. And why is that? I think fundamentally, on a structural basis, we think that the Chinese economy is still a very strong economy. The light green bar shows that the overall savings rate is above 30% for the average Chinese consumer. Contrast that with the US and the European areas, meaning that they don't really save. And importantly, savings is the basis for building any strong economy. Importantly, not only do they save, but they are exporting more than they import. So notwithstanding the tariffs that might come from the US if Donald Trump gets elected, there's still many other countries that China are exporting to, and we think that their trade balance will continue to be very robust even post-election. Importantly, the key catalyst will be getting the Chinese consumer to spend more. This is consumer confidence across different metrics, both confidence on employment, on income. All of them you can see fell off during COVID and haven't returned in China. So fundamentally, they're strong, they lack confidence. We think that there will come a point where things stabilize and start improving again fundamentally in the Chinese economy. And therefore, we think there's still a fair way to go on the Chinese equity market. I think on the US side of things, it's a bit tougher. Yes, they've had a great run. Yes, it's been amazing if you invested in the US stock market. However, whether it is Harris that wins the election or whether it's Donald Trump that wins the election, they are inheriting a much tougher world, or at least a much tougher base to grow off. When Donald Trump first came in 2016, the S&P was only just over 2,000. It's now heading towards 6,000. The US housing market has doubled. The average house is practically doubled. The equity market PE, as you can see there, is almost 24, 25 times with a huge budget deficit. So it is a really tough base. Yes, there is going to be an effort by either one of them to continue to grow. It just is much tougher this time around. The other big point that people expect is obviously as soon as you get a rate cutting cycle, people get very excited about owning equities. All this chart shows you is the market performance that comes directly after the first rate cutting cycle. And you can see the green lines are when effectively you avoid a recession, and the red lines are when actually you have a cutting cycle, but you still have a recession. And what we're saying there is two things are important. Obviously, forward-looking how the economy does is important, but also the starting PE is relatively important. And notwithstanding the expectation that rate cuts are good for markets, it does importantly need some context. Turning to South Africa, so obviously South Africa is very important to see what's happening with the GNU. I think this is, although you've got to bear in mind that the latest data are the black bars, which are to the left, which is a slightly strange way to look at the chart. But as you can see, this is data from the Social Research Foundation that came out in October, showing what the election would look like if people voted today. And as you can see, interestingly enough, most of the participants in the GNU are going up. You can see, interestingly, that the ANC, if the election were to happen today, based on the latest survey, ANC would be up, DA would be up, PA would be up, and the IFP would also be up, whereas the EFF and MK would be down. I think, importantly, these are just research data points. We don't put too much store in it, but we do feel that the GNU has imbued a positivity into the SA economy, and I do think that this is one of the signs that at least it is benefiting the parties that are part of the GNU. So that positivity, notwithstanding some of the resource prices that have come down, like the PGMs, gold has been strong, sentiment has been good. You can see the green line, which is the rand through time, and then the unit labor cost line would be the black line, indicating where a long-term rand should be. You can see that the green line has strengthened substantially towards the long-term rate. And for all intents and purposes, we think that the rand will operate between the black line and the top part of the red line as things move out into the future. So the rand is okay and fairly valued, but we're operating with, I guess, mid-17s to mid-18s as a through-the-cycle range, given some of the constraints that we still yet to prove that we have overcome. If you see that rand in the context of a really, I wouldn't say weak oil price, but I guess an oil price that hasn't gone up very much, the contribution to the overall inflation in the SA economy will see a negative contribution from rand oil or petrol price into the SA economy. So you have better electricity, which is obviously helping firms from a production point of view. You have tactical reasons to be positive around petrol's contribution to inflation, and therefore the cash yields have come down even on a 5-year basis. You were yielding over 10% on a 5-year basis only a few months ago. You can see through to September now we're expecting, or the market is expecting, less than 9%. Why is that? I think we still think that the inflation from, notwithstanding the oil price, notwithstanding some of the other benefits like having no load shedding, structural administrative costs remain high. You can see that this is a forecast by government showing where they think that structural administrative costs will be. You can still see it's at the upper bound of 6%. Also importantly, the surveys on a 2-year basis with business still expect quite high inflation. So I think we don't think we've vanquished inflation, even though we might see some 3 and 4% inflations over the next year. So where is the yield and where is the benefit going to come from in the portfolio? You can get 4.5% above inflation by buying a 5-year inflation adjusted bond. You can see only in 2014 this was negative. They're still offering a really good yield, and I think this is one of the biggest opportunities for the stable fund. Fixed coupon bonds remain, or having re-rated, are relatively expensive, although the inflation-linked bonds are where the opportunity is. So as you can see from this chart, I've done a really interesting thing where I have, instead of using math speak, put 2 scenarios of 4.4% inflation and 6% inflation. On the left-hand side of the chart, you can see that if 4.4% inflation is achieved over the next 5 years, the nominal bond and the inflation-linked bond will be equal. That is the break-even point that they call, where they both will outperform NCDs, which is cash, on the left if 4.4% inflation comes through. Having said that, if anything above 4.4% inflation comes through, and we use the 6% inflation on the chart on the other side, you will far outperform with an inflation linker. So what we're saying is risk-adjusted, anything below 4.4 on a 5-year basis, which we think is a relatively low probability, means that inflation linkers underperform. But on the other side of that, anything above 4.4, inflation linkers really do outperform. So I do think that it is a really good way to manage risk of, I guess, longer-term structural inflation. Putting it all together, what have we done? September on September, you can see that foreign equities has gone up. We still think it's a really good place to find opportunities, given the opportunity set we can find offshore. We are at near 40% when you sum up the foreign equities with the local equities. And importantly, although bonds have gone down slightly, the mix has also changed, that we have more inflation linkers and less fixed coupon bonds. We still continue to have a 5% allocation to JSE commodities, which is basically the listed gold ETF, which will provide a great diversifier if something were to happen that's unforeseen. So that was a quick whirlwind quarterly update on the Nedgroup Stable Fund. I'm now going to hand back to Anil.